Have you seen what's happening to healthcare stocks right now? UnitedHealth Group, America's largest health insurer, has crashed 46.69% in the past 6 months. That's not a typo. Nearly half its value, gone. The broader healthcare sector is down over 10% in the same period. And Wall Street analysts are running for the exits. But yesterday, I put 20% of my investment portfolio into these exact stocks that everyone else is dumping. Am I insane? Or is this the buying opportunity of the decade? Let me show you the data that convinced me to go all in while everyone else is panicking. Let's be honest, it's been brutal. UnitedHealth Group has collapsed 46.69% in 6 months. That's nearly half its value, gone. In just the last 30 days, down 45.93%. And this isn't some tiny tech stock. This is a $300 billion titan in American healthcare. Year to date, still crashing, down 36.67%. The bloodbath doesn't stop there. XLV, the ETF tracking the entire healthcare sector, is down over 10% in that same time frame. This is one of the worst 6-month stretches for healthcare in recent memory. And yet, I just went all in. Let me show you exactly why. 3 main factors are behind this healthcare crash. First, UnitedHealth shocked the market by suspending its 2025 financial outlook. The company cited unexpectedly high medical costs in its Medicare Advantage plans. Basically, they're paying out more in claims than they anticipated. Second, UnitedHealth's CEO Andrew Whitty abruptly resigned, with former CEO Stephen Hemsley stepping in as interim leader. Nothing spooks Wall Street more than unexpected CEO departures. Third, there's been a broader post-COVID normalization in healthcare spending and utilization. During the pandemic, healthcare spending surged 10.6%. It's now moderating to more normal levels, around 4.1% growth. This perfect storm has created panic. While most investors are running scared, I'm seeing something completely different in the data. I'm seeing a historic buying opportunity. Let me show you why. First, let's look at valuations. UnitedHealth's trailing PE ratio has compressed to approximately 13.0. That's not just low, it's nearly a 10-year low for the company. For perspective, UNH's 5-year average PE is 25.74. Its recent 12-month average PE was 33.67. This means UNH is trading at roughly half its normal valuation. The broader healthcare sector is showing similar value. XLV's forward PE ratio is currently around 16.25, below its 3-year average of 28.2 and 5-year average of 27.1. For context, the S&P 500's PE ratio is approximately 28. So healthcare stocks are trading at massive discounts to both their historical valuations and the broader market. So what's really going wrong with UnitedHealth? And is it fixable? The answer could make or break this entire investment thesis. Here's the distinction I use. Are we looking at temporary chaos or a structural breakdown? Temporary issues hurt, but pass. Structural ones change the entire game. And based on the data, I believe this is the former, a painful reset, not a permanent decline. Here's why I'm confident in that call. Temporary issues can be resolved within 1 to 2 business cycles. They hurt in the short term, but don't permanently damage the business model. Structural issues represent fundamental, long-term changes to how a business operates or makes money. The data suggests UnitedHealth's Medicare Advantage challenges are temporary. They've specifically highlighted unanticipated changes in the profile of Optum Health members impacting planned 2025 reimbursement due to unexpectedly minimal 2024 beneficiary engagement by plans exiting markets. In plain English, as less stable insurers leave certain markets, UNH is absorbing their members. These new members often have higher initial medical costs until their care is properly managed. UNH has navigated similar challenges before. Their scale, diversification, and management expertise give them powerful tools to adapt. Meanwhile, the long-term tailwinds for healthcare remain stronger than ever. The aging population continues to drive demand. By 2040, 22% of Americans will be 65 or older, up from 17% in 2020. Healthcare spending consistently grows faster than GDP. In 2023, national health spending increased 7.5% to $4.9 trillion. And innovation in treatments and technology creates new revenue streams every year. But the most compelling reason I'm buying isn't just the discounted valuation or the long-term growth story. It's UnitedHealth's diversified business model. Many investors forget that UNH isn't just an insurer. Its Optum segment, encompassing pharmacy benefits, healthcare delivery, and data analytics, is a $300 billion revenue powerhouse. Optum Health was on track to add 650,000 new patients to its value-based care arrangements in 2025. Optum Rx reported a 14% revenue increase in Q1 2025, exceeding $35 billion. This diversification provides significant protection against issues in any single business segment. And then there's the value proposition for income investors. UNH's dividend yield has jumped to between 2.22% and 2.70%, significantly higher than its historical average. The company has increased its dividend for 16 consecutive years. This provides a nice payment while you wait for the stock to recover. So what's my strategy here? I'm making 3 specific moves in healthcare right now. First, I've allocated 15% of my portfolio to UNH at current levels around $311. I plan to add another 5% if it drops below $290. This gives me exposure to what I believe is the highest quality company in the space at a steep discount. Second, I've put 5% into XLV, the healthcare sector ETF. This gives me broader exposure to the sector, including pharmaceutical and biotech companies that could recover more quickly. Interestingly, if we look at XLV's holdings, UNH is still the 4th largest position at 5.97% of assets, behind Eli Lilly, Johnson & Johnson, and AbbVie. Third, I've allocated 5% to IHI, the iShares US Medical Devices ETF. Unlike the broader healthcare sector, medical devices have shown remarkable resilience. IHI is actually UP 5.17% year-to-date and 7.80% in the past month. Its 6-month return is positive 2.58% compared to XLV's negative 10.06%. This suggests the market is already distinguishing between different healthcare segments, with medical devices seen as more stable and less affected by the issues impacting insurers. IHI's top holdings include Abbott Laboratories at 17.96% and Intuitive Surgical at 16.14%, companies with strong fundamentals and less exposure to insurance reimbursement volatility. Now, to be clear, I'm not saying these stocks will immediately bounce back. Short-term volatility could continue. We could even see additional downside before a recovery. UNH management has specifically stated they don't expect to resume their normal earnings growth trajectory until 2026. But for investors with a 2 to 3 year time horizon, I believe the current prices represent exceptional value. Historical patterns support this view. Healthcare stocks have experienced several significant drawdowns over the past decades, including during the 2008 financial crisis and the 2020 pandemic. In each case, the sector not only recovered but went on to reach new highs. During the COVID crash of March 2020, healthcare stocks fell approximately 30% before staging a powerful rally. The current situation reminds me of that opportunity, though for different reasons. So what specific metrics am I watching to confirm my thesis? First, I'm monitoring UNH's medical loss ratio, the percentage of premiums paid out for claims. If this stabilizes in the next 1 to 2 quarters, it would signal they've gotten their arms around the Medicare Advantage issues. Second, I'm watching Optum's revenue growth. Continued strength here would confirm that UNH's diversification strategy is working. Third, I'm looking for signs of strategic adjustments in their Medicare Advantage bidding process for 2026. Management has already indicated they'll realign bids to reflect current utilization trends. Of course, there are risks to this approach. If the Medicare Advantage issues prove more structural than temporary, or if healthcare regulation changes significantly, the recovery could take longer than expected. This is why position sizing is critical. While 25% of my portfolio is substantial, it still leaves 75% allocated elsewhere, providing diversification. So what should you do with this information? If you're considering adding healthcare stocks to your portfolio, here are 3 key steps. First, do your own research. While the data I've shared is compelling, your financial situation is unique. Second, consider dollar cost averaging rather than investing all at once. This helps manage the risk of continued volatility. Third, maintain a long-term perspective. The thesis for these investments isn't about next week or even next month. It's about the next few years. Warren Buffett famously said to be fearful when others are greedy and greedy when others are fearful. Right now, fear in healthcare stocks is at levels we rarely see. For contrarian investors willing to look beyond the headlines, this creates a potential opportunity to buy high-quality businesses at deep discounts. The last time UNH traded at these valuations and subsequently recovered, investors saw gains exceeding 100% over the following 2 to 3 years. Will history repeat itself? Only time will tell. But the data suggests the odds are in our favor. That's why I'm all in on these beaten-down healthcare stocks. How about you? Are you seeing opportunity in this healthcare crash, or do you think there's more pain ahead? Let me know in the comments below, and hit subscribe if you want more data-driven analysis of market opportunities. Thanks for watching, and I'll see you in the next video.